Hey traders, thanks for joining me once more. In my previous video on how to easily spot reversals, we talked about how to look at how to create a macro view of where a reversal may take place. However, when price gets down to one of these levels, what gives you further confirmation that price will indeed reverse and head in the direction you expect, instead of going the opposite way and stopping you out? Well, it's chart patterns. And that's why I want to take you through 3 ultimate reversal chart patterns Forex style. I am creating 2 videos per week packed with Forex tips, tricks, and strategies, so make sure you smash that subscribe button to be notified of my future videos. Now, put simply, these chart patterns will further confirm that the current winners in the Forex battle, that is buyers in a bullish move or sellers in a bearish move, have run out of juice, and the opponents may be about to take over and carry price in the opposite direction, allowing you to profit from that directional move. It needs to be noted that you are looking for these patterns to form at the level or levels we talked about in the previous video. That's why I strongly recommend you watch that video before watching this video, and the link will be appearing in the top right of your screen right now. I'll go into more detail on these points as I take you through the patterns. So, without further ado, let's get into it. First up, we have double tops and double bottoms. Now, I want to introduce you to one of the most common and well-known reversal patterns. People absolutely love to trade these patterns because they are accurate, common on the charts, and relatively easy to spot. So, a double top is formed after a period of bullish price action. Price bounces, forming the first top. Price then bounces again and forms what's known as the neckline. Price then bounces from that neckline and rises back up, forming the second top. And the double bottom is simply the reverse of this. Now, this is important. For the double top or double bottom to be valid, price must rise to the same level or just below the level of the first top or bottom. Once price has gone beyond the first level, this pattern is invalidated. So after forming that second top or bottom, price will then reverse again and head back towards that neckline, confirming and forming the second top or bottom. Now, people will trade this pattern in 2 different ways based on their risk preference. Those who wish to take more risk but go for more profit will try and judge where the second top or bottom has formed and enter at this point. Those who want to take slightly less risk but also potentially a little less profit will look to enter once price has broken down below the neckline. Let's take a look at a real example in the Euro-US dollar chart. Here we can see that the price of the market had been bullish for quite some time. We see that the first top formed here, right at a major monthly support and resistance level around that 13,917 level. The market price then sunk to 13,700, forming the neckline, before bouncing and heading right back up to that same 13,917 level, forming the second top. It is important to note here that although this wick is higher than the previous top, the body of the candlestick did not finish above the previous top, meaning that the pattern remained valid. The market price then broke down with heavy bearish momentum for a long period of time. Don't forget guys, if you want to ask me any questions about the stuff covered in today's videos or any other Forex related questions, just leave me a comment. I will always respond. Okay, so number 2 we have head and shoulders and inverse head and shoulders. So, now we have the pattern that is widely regarded by traders and analysts to be the most accurate of all reversal patterns. The pattern is signified by 3 peaks. The first 2 peaks are similar in height and the third middle peak is higher. The 2 lower levels in the head and shoulders pattern are what form the shoulders, and the middle higher level is what forms the head. This pattern also has a neckline, and that is drawn so the lowest point of the retracement from the first shoulder and the lowest point of the retracement from the head are joined. It is important to note that the neckline does not have to be horizontal. It can also be sloping. For the inverse head and shoulders, the reverse is true. The pattern is confirmed once price breaks down past the neckline, and this is where traders will look to enter the market. Here on the Euro-Japanese Yen chart, we can see an inverse head and shoulders pattern formed right on a medium weekly level of support. The price of the market had been decreasing and the first shoulder was formed around that 11,565 level. Price then bounced and increased to around 11,727, which was the same level as the previous lows. Which, it should be noted, was the same level as the two previous lows, forming the first part of the neckline. Price then decreased again down to around the 11,453 level to form the head. Price bounced, rose back to around 11,639 to form the second point of the neckline. The price of the market then once again increased to around the same level as the first shoulder to form the second shoulder. The market then duly reversed and rose heavily. Now you should notice the steep sloping neckline on this particular inverse head and shoulder pattern. As noted before, the neckline does not have to be horizontal. So third and finally we have rising and falling wedges. Now these patterns are a little more complicated, but still great indications and further confirmations that a reversal may be about to take place. The rising wedge is a sign that the market may be about to reverse and become bearish, and the falling wedge is a sign that the market may be about to reverse and become bullish. Both of these patterns are created by drawing two trend lines. The upper one runs through the market highs, the lower one runs through the market lows. In the rising wedge, both trend lines are ascending, and the slope of the support line must be steeper than that of the resistance line. To trade this pattern, traders will wait for the price of the market to break down below the support trend line. In the falling wedge, on the other hand, both trend lines are descending, and the slope of the resistance line is steeper than that of the support line. Once again, with this pattern, traders will wait for price to break above the resistance trend line, as indication that the market is about to undergo bullish action. Here we can see an example of a rising wedge in the Euro-US dollar chart. Price came down to around the 12,510 level. It then rose up to around that 12,730 level, forming the first point of resistance. The market then retraced and headed back to the 12,631 level. Now, that first bounce at 12,510 and the bottom of this latest retracement give us our support level. The market then again increased up to around the 12,825 level, giving us another upper level of resistance before breaking back down to trendline support and then finally breaking through and undergoing some heavy bearish momentum. It is important to note that the final top resistance level coincided with a daily horizontal resistance level. So these reversal chart patterns are a fantastic extra level of confirmation for you. However, they should be added on to a base strategy. This is what I have provided in my 100% free ebook, which I have created for you, called the 3-Step Trading System, which details the basic strategy that I started out with to trade successfully in the markets. Simply go to www.theposhenglishtrader.com/3steps to download that now completely free. Once again, simply type into your browser address bar www.theposhenglishtrader.com/3steps or simply click on the link in the video description below. I'll be creating another video very soon which looks at another level of confirmation for reversals which could drastically increase the success of your trades. So make sure you hit that subscribe button so you don't miss that video. Okay guys, until next time.